Welcome back to the deep dive. Look, I get it. Taxes. Usually not the first thing you think of when you picture a fascinating deep dive. But trust me on this one. Understanding how individual income tax actually works is, well, it's not just crucial, it's genuinely empowering. Kind of like getting the secret cheat code to your own finances. So today we're doing exactly that. We're diving headfirst into the core mechanics of individual income tax. We've pulled insights from a whole stack of comprehensive sources covering, everything from what counts as income to how your filing status gets determined and even who gets to be a dependent in the eyes of the taxman.
Yeah, our mission today is really to cut through the jargon, to demystify these foundational elements. We want to make sure you walk away with a clear, actionable understanding of how your income is taxed, how your personal situation impacts your filing status, and ultimately how to make sense of your whole tax picture. And, seriously, no prior tax knowledge needed will guide you through it.
Okay, let's unpack this then. The entire journey, the whole process of individual taxation, it really starts with a formula. Now, don't let that word formula scare you off. Think of it less like a scary math problem and more like your financial GPS. It guides you from your total earnings all the way to what you ultimately owe, or even better, what you get back as a refund. It's a structured path, and we're going to navigate it piece by piece.
Exactly. And at the very start of that journey, your starting point is gross income. This is essentially, all your earnings before you take anything away. What's kind of surprising here is just how broad this category actually is.
Right.
It includes the obvious stuff like your wages, interest from savings, maybe dividends from investments. But it also covers things like state tax refunds you might get back, any income from a business you run, capital gains or losses from selling assets, and income from retirement accounts, IRAs, pensions, annuities, even things like rental income, unemployment benefits, Social Security benefits can be part of this. There are also specific rules for things like alimony received, but that depends on when the agreements were made. The main thing is, if you earned it, the IRS probably considers it income.
Okay, so that's the big pool of money you start with.
That's it. From that broad gross income, we then take away certain things called adjustments. Think of these as specific kind of pre-approved subtractions that reduce your income right off the top. They're important because they directly lower your income before you get to a really significant number. Your adjusted gross income, or AGI. Common examples. Well, money you put into a traditional IRA, student loan interest you paid, maybe contributions to a health savings account.
Right, I've heard of those.
Yeah, and if you're self-employed, maybe part of your self-employment taxes or your health insurance premiums might count here. There are also specific rules for things like alimony paid under certain agreements and even moving expenses, but only for military orders now. These adjustments are basically the government's way of encouraging certain things.
Gotcha.
Incentives.
Exactly.
Yeah.
So once you subtract those adjustments from your gross income, you land on adjusted gross income, or AGI. This is a really crucial number, like a major landmark on that financial GPS we talked about.
Why is it so important?
Because this single number, AGI, is often the baseline used to calculate limits on many other deductions and credits later in the process. It's arguably the most important number on your tax return.
Okay, AGI. So once you have that, you mentioned a crossroads. You have to choose something.
That's right. You then choose between taking the standard deduction or itemizing your deductions, taking itemized deductions. It's a bit like choosing the scenic route versus the direct highway. You pick the one that results in the lowest tax.
Okay, so most people just take the standard one. Yeah, most people find the standard deduction is simpler and often higher. But if your specific deductible expenses add up to more than the standard amount, you'll want to itemize. What kind of things are we talking about for itemizing?
Right. What qualifies?
Well, our source material highlights things like medical expenses, but only the amount that's over a certain percentage of your AGI. Then there's state and local taxes paid SALT, though there's a pretty significant cap on that now, $10,000 per household.
Ah, yes, that limit.
Interest paid on your home mortgage and sometimes on investment loans. Charitable contributions you make, those also have limits based on your AGI and what you donate. And deductions for casualty or theft losses, but these are pretty restricted now, generally only for federally declared disaster areas, and they have their own thresholds too.
So you really need to have significant expenses in those specific categories for itemizing to make sense.
Precisely. After you've subtracted either your standard or your itemized deductions, you get to something called taxable income before QBI deduction. Then you subtract the QBI deduction itself if you qualify. That's for qualified business income. And that finally gets you to your main taxable income. This is the actual dollar amount that your federal income tax rate is applied to. It's the number used for the actual tax calculation.
Okay, the target number.
The target number. From the tax calculated on that income, your federal income tax liability, you then subtract any tax credits you might qualify for.
And credits are better than deductions, right?
Absolutely. They're much more powerful because, unlike deductions, which just reduce the income subject to tax, credits reduce your actual tax bill, dollar for dollar. $100 credit. That's $100 less you pay in tax. Huge difference.
Got it.
After credits, you might add in any other specific taxes that apply. Then you factor in the payments you've already made during the year, usually through payroll withholding from your job.
Right, the money already taken out.
Exactly. And finally, all those steps, all those calculations lead you to the end result. Whether you have tax due, meaning you owe more, or you get a refund.
So this whole formula, this financial GPS, what does understanding this flow really mean for you, the listener? I mean, seeing how every dollar earned, every deduction, every credit fits together, it's fundamental, isn't it? It's not just about filling out forms. It's really your personal roadmap to understanding your tax situation. It can make tax season feel a lot less like a black box and more like a solvable puzzle.
Absolutely. And that clarity naturally leads to the next question. Okay, who actually needs to go through this whole filing process? Who has to file a tax return?
Yeah, does everyone?
Not necessarily. The general rule is pretty clear. If your gross income, that starting number we talked about, is equal to or greater than the standard deduction amount for your specific filing status, plus any extra standard deduction if you're 65 or older or blind, then you probably need to file. There's an exception for married filing separately, but that's the gist. It's basically a threshold to avoid making people with very little income file.
Okay, that makes sense. And here's where it gets really practical for everyone. When? When do you actually have to file by?
Good news is it's usually pretty consistent. The main due date is April 15th.
The dreaded April 15th.
The very same. Now, if April 15th sneaks up on you, or life just, gets complicated, don't panic. There's an automatic 6-month extension available that pushes the filing deadline to October 15th.
Automatic. So you don't have to beg.
Nope. You just need to file a simple Form 4868, by the original April 15th deadline. But, and this is the really crucial point, a big one people often miss this extension, is only for filing the paperwork. It is not an extension for paying any taxes you owe.
Ah. So payment is still due April 15th.
Payment is still due April 15th, absolutely. Think of it like getting extra time to turn in your term paper, but your tuition payment was still due on the original date. Same idea, no getting around the payment deadline.
Okay, critical distinction there. So we know who generally files and when. Now let's talk about how you file, because you mentioned filing status. And that can dramatically change the final outcome, right?
Yeah.
It affects your standard deduction, your tax brackets.
It has a huge impact. Your filing status isn't just some random checkbox, it's a critical decision. And most of these statuses depend on your situation on the very last day of the tax year, December 31st. Let's start with the simplest one. Single. Pretty straightforward. This is you if you're unmarried or legally separated at the end of the year.
Easy enough.
Then we have joint returns. To file jointly, you generally must be married by the end of the year. This includes legally recognized common law marriages, too. If you got married on, say, December 30th, you can still file jointly for the entire year.
Oh, interesting.
But if you got divorced during the year, even on December 30th, then no joint return for that year. One interesting point. If one spouse passes away during the year, the surviving spouse can usually still file a joint return for that year.
Okay. And what about couples who are married but decide not to file jointly? Maybe they want to keep finances separate, or there's some strategic reason. That's married filing separately, I assume. Like you mentioned something about where you live matters here.
Exactly. A married couple can choose to file separately. And yes, the nuance involves state law. In what are called separate property states, you generally just report your own income, your own deductions. But in community property states, think California, Texas, a few others, most income and assets acquired during the marriage are considered owned 50-50.
So even if only one person earned the money?
Right. Even then, most income deductions, credits often get split down the middle between the spouses on their separate returns. It's a pretty significant difference depending on your state.
Wow, okay. Need to know your state rules there.
Definitely. Then there's a status called qualifying widow with dependent child. This one offers a real benefit. It lets you use the same standard deduction and tax rates as a joint return for up to 2 years after your spouse's death.
That sounds helpful during a tough time.
It is, but the requirements are strict. You can't have remarried, and crucially, you must have paid over half the cost of maintaining a household that was the principal home for a dependent child for the entire taxable year. Not just part of the year, the whole year.
Okay, whole year is key there. And finally, there's one that often gives a tax advantage. Head of household. This one usually means lower taxes because it has a larger standard deduction than single or married filing separately, and the tax brackets are often wider, meaning more income is taxed at lower rates. What are the main conditions for this one?
Right, head of household can be beneficial. Generally, you need to be unmarried, legally separated, or considered unmarried because you lived apart from your spouse for the last 6 months of the year. You also can't be using that qualifying widow status we just mentioned, and you can't be a non-resident alien. But the most important piece is that you must maintain a home that, for more than half the year, is the principal residence of a qualifying person.
More than half the year this time. Okay.
Yeah, see the difference? Widow was whole year, head of household is more than half. This rule really shows the government trying to recognize the financial burden of, well, heading up a household.
So who counts as this qualifying person for head of household?
Good question. There are a few possibilities. It could be your qualifying child. This includes your actual child, stepchild, adopted child, foster child, brother or sister, or their descendants, and they have to live with you.
Okay.
It could also be your father or mother. They're kind of a special case because they don't actually have to live with you. As long as you maintain a home that was their principal residence for the entire year, meaning you paid over half the cost of the upkeep, like their rent or nursing home costs, or utilities they can qualify you for, head of household status, even if they live elsewhere.
That's a really specific rule for parents.
It is. And lastly, other dependent relatives can qualify you, but they must live with you for more than half the year. This includes people like grandparents, aunts, uncles, nieces, nephews, step-siblings, in-laws. But it's important to note, for head of household purposes, cousins or foster parents don't count as relatives in this context unless they happen to live with you the entire year under the non-relative rule.
Okay, that's a lot of detail on who qualifies and for how long they need to live there. It really seems like the timing whole year versus more than half a year is critical.
It absolutely is. It really highlights how precise these tax rules are designed to be. Like we saw, for a widower, that dependent child needs to be in the home for the whole year. For head of household, the qualifying person needs to be there for more than half a year. These specific time frames aren't arbitrary. They're there to try and ensure fairness and target the tax benefits correctly based on different family structures and support situations.
Which leads us nicely into the next big topic, dependents. This section is incredibly important, right? Because having qualifying dependents can unlock some really significant tax benefits, like those filing statuses we just talked about, or certain tax credits. But what actually defines a dependent in the eyes of the IRS? It's not just like who you buy groceries for, is it?
No, it's definitely more specific than that. You're right, it's very important. There are basically two main categories of dependents, a qualifying child and a qualifying relative. And to help everyone remember that the tests involved, tax pros often use these little mnemonics: CARES for a qualifying child and support for a qualifying relative.
CARES and support. Okay.
The core idea behind both is that you generally get tax benefits for anyone you truly cares for or supports financially. And this applies even if they were born or passed away during the tax year. Just a small note. They usually need a social security number if they're age 1 or older by year end.
All right, let's break down CARES for a qualifying child first.
Okay, C is for close relative. This is specific. It has to be your son, daughter, stepson, stepdaughter, brother, sister, stepbrother, stepsister, or a descendant of any of them, like a grandchild. It also includes legally adopted children and foster children placed with you by an authorized agency or court.
Got it. Close family ties.
Right. Next, A is for age limit. Generally, the child must be younger than you and under age 19 at the end of the year, or under age 24 if they're a full-time student for at least part of 5 calendar months during the year.
Under 19 or under 24 and a student, what about disability?
Good point. There's no age limit if the individual is totally and permanently disabled at any time during the year.
Okay. What's our R?
R is for residency and filing requirements. The child must have lived with you as their main home, their principal abode, for more than half of the tax year. Temporary absences, like for school or vacation, usually don't count against this. They also generally have to be a U.S. citizen or a resident of the U.S., Canada, or Mexico. And, importantly, The child generally cannot file a joint tax return with someone else, like a spouse, unless they're only filing it to get a refund of taxes withheld and owe no tax.
Okay, lived with you more than half the year, citizenship residency, no joint return. What's E?
E is for a limited gross income test. This is a really key difference compared to the other type of dependent. For a qualifying child, we don't care how much income they earn. A child could earn, say, $10,000 from a summer job and still potentially be your qualifying child dependent. Their income doesn't disqualify them.
That's a big one. Okay, and S?
S is for support test, but it's a specific kind of support test for a qualifying child. The child must not have provided more than half of their own financial support for the year. It's not about how much you provided, but whether they supported themselves more than 50%.
Okay, so they can't pay for most of their own way. What counts as support?
Support generally means the actual expenses paid for their well-being, food, shelter, clothing, education, medical care, etc. There's a special rule here for scholarships. If your child, son, daughter, stepchild, is a full-time student, any scholarship money they receive for school is not counted as support they provided for themselves. That helps parents continue claiming students as dependents. But note, this scholarship exclusion doesn't apply if the student is, say, your sibling or grandchild.
Interesting detail on scholarships. Okay, that's CARES for a qualifying child.
Yeah.
Now, what about the other category, qualifying relative, using support?
Right, now we switch gears to qualifying relative and the support tests. First, S is for support test. This time, it's about you. You, the taxpayer, must have provided more than 50% of that person's total support for the entire year. Same definition of support applies food, lodging, etc.
So for a relative, it's about you providing the majority of the support.
Got it.
U is for under gross income limitation. This is another major difference from a qualifying child. To be a qualifying relative, the person's gross income for the year must be less than a specific amount set by the IRS. This amount changes slightly each year due to inflation, but for 2023, it was $4,700.
Less than $4,700. Does all income count towards that?
Only taxable gross income counts. Things like non-taxable Social Security benefits, tax-exempt interest, or tax-exempt scholarships generally don't count towards this limit. So someone could have more than $4,700 in total receipts, but still be under the limit if enough of it was non-taxable.
Okay, that's a key distinction. P.
P is for precludes dependent filing a joint return. This is similar to the rule for a qualifying child. You generally cannot claim someone as a qualifying relative if they're married and file a joint return themselves, unless, again, that return is filed only to claim a refund and they wouldn't owe tax if they filed separately.
Makes sense. Oh.
O is for only citizens of the United States or residents of the United States, Mexico, or Canada. The person must meet this citizenship or residency requirement, same as for a qualifying child.
Okay. And finally, R and T.
Right. R is for relative, or T is for taxpayer lives with the individual for the whole year if they are a non-relative. This is the relationship test. The person either has to be your relative, and the list is quite broad. Children, grandchildren, parents, grandparents, siblings, aunts, uncles, nieces, nephews, and even in-laws like stepchildren, step-parents, step-siblings.
Wow, that covers a lot of family.
It does. But notice who isn't on that list typically. Cousins and foster parents aren't considered relatives for this specific test. However, if the person is not on that list of relatives, like a cousin, a foster parent, or even just an unrelated friend, they can still potentially be your qualifying relative if they live with you as a member of your household for the entire year, and the relationship can't violate local law.
Ah, so that's how a non-relative could qualify, but only if they live with you all year long.
Exactly. So if we kind of tie this all together, these detailed rules for dependents, both CARES and support, they really underscore how important it is to keep good records. You know, who lived in your house and for how long, who actually paid for whose support. It's not just about family relationships on paper, it's about the reality of the living arrangements and the financial support provided.
That makes perfect sense. And sometimes situations get complicated, like when multiple people are helping support someone. You mentioned something called multiple support agreements. How does that work if no single person pays over half?
Yeah, this is a really useful rule for some families. Let's say you have maybe several siblings supporting an elderly parent. If two or more of those people together contribute more than 50% of the parent's support, and each of those individuals contributed more than 10% of the support, and the person being supported meets all the other dependency tests, like the income limit for a qualifying relative, then those contributors who each gave more than 10% can basically agree among themselves who gets to claim the parent as a dependent for that year.
So they can decide who gets the tax benefit.
Exactly. The person claiming the dependent needs to get signed statements from the other eligible contributors saying they won't claim the dependent, and they attach a form, Form 2120, to their tax return.
Let's use that example from the source material, the one about Peter. That really clarified it for me. Peter is single, no income, and he's supported by 3 people. Tim, who's an unrelated friend, 48% support. Angie, Peter's sister, 43% support. And Mike, Peter's son, only 9% support. Who could claim Peter?
Right, great example. In that scenario, Peter could only be claimed as a dependent by his sister Angie. Why? Well, Tim, the friend, even though he provided the most support, 48%, isn't a relative and didn't live with Peter all year, so he fails the R or T test for a qualifying relative. Mike, the son, is a relative, but he only provided 9% support, which is below the 10% threshold needed to be part of a multiple support agreement.
So Angie's the only one who meets all the requirements. She's a relative, she provided more than 10%, and presumably she and Tim together provided over 50%.
Exactly. Assuming Peter met the other tests, like the income limit, Angie could potentially claim him, possibly using a multiple support agreement if she got Tim's sign-off, even though Tim couldn't claim Peter himself. It really shows how you have to tick all the boxes for dependency, not just the support one.
It really does. Okay, one last tricky area, especially for families navigating separation. Children of divorced parents. How does the IRS decide who gets to claim the child as a dependent? Is it just whoever pays child support?
Not necessarily based on who pays support. The general rule here focuses on custody. The custodial parent, which is defined as the parent who has the child living with them for the greater number of nights during the year, is generally the one entitled to claim the child as a dependent. This is based on a time test, not necessarily what the divorce decree might say about who can claim the child.
So it's about where the child physically spends more time.
Primarily, yes. It applies regardless of which parent actually provided more than half the child's financial support. Now, there can be agreements where the custodial parent releases the claim to the non-custodial parent using a specific form, but the default is the custodial parent based on time.
What if they have exactly equal custody time?
Ah, the tiebreaker. If the parents have perfectly equal custody time during the year, then the parent with the higher adjusted gross income, AGI, gets to claim the tax benefits associated with the child. It's a very practical way to resolve that specific situation.
Wow, okay, that was genuinely a comprehensive deep dive into the foundations of individual income tax. From that financial GPS formula that takes your earnings down to taxable income, to understanding all the nuances of filing statuses, and those really intricate rules for who counts as a dependent. We definitely unpacked a lot today.
Yeah, and what's really striking, I think, is how interconnected all these pieces are. You know, a seemingly small detail like your marital status on December 31st, or exactly how many months someone lived with you, or whether their income was just over that qualifying relative threshold, it can have pretty significant ripple effects on your overall tax situation. It's a complex system for sure, but there is a logic to it. Understanding that logic is really powerful.
And that's exactly why getting a handle on these core concepts is so beneficial for you listening right now. It's not about trying to memorize every single rule variation. It's about grasping the main principles. That way you can ask better questions, maybe spot potential deductions or credits you weren't aware of, make more informed decisions about your finances throughout the year, and just feel, well, more in control when tax time inevitably rolls around.
That clarity, that understanding, it really does raise an important question, doesn't it? Now that you have a clearer picture of these foundational tax elements, the formula, statuses, dependence, how might this new knowledge actually change the way you approach your own financial planning? Or maybe even just how you think about everyday conversations with family about things like support or shared living expenses?
Definitely something to ponder until our next deep dive.